Hey, it's Claire here. I hope you're well. I've got a video for you today on how to analyse deals, as this is something that one of the group members asked me if I could do, and I thought it would be useful potentially for other group members as well. So I'm just going to give you an overview, and then I'm going to give you an example of a deal analysis that I just put together just to show you how I would look at a deal. So in terms of an overview, so the approach I've taken for this video is to look at it from a cash perspective, since cash is king. And most property investors are interested in the cash that you're going to get from your investment. So what I've done here is I've listed out typical cash flows that you get in property. Now, some of these are only relevant for some strategies, so I'm not going to cover those in detail today, but I'll mention what those are just so that you're aware of those. Almost all strategies are going to have some sort of upfront costs involved. So whether even if that's just training, there might be legal costs or some refurbishment costs. So there's a bunch of upfront costs that you can expect to incur. So that is something we'd want to include in our analysis. If you're doing a property up and then you're going to get it revalued and then refinance it, then that would be a separate set of cash flows that you'd want to build out. So if you're going to do a buy, refurbish and refinance, now you'd only do that in some circumstances. So I'm not going to cover that in the deal model today, but I can do a video on it for the future if there's enough interest in that. Similarly, for the next set of revenues and costs, you might get some one-off revenues or one-off costs. So here, particularly if you're flipping a property, so by that I mean you're buying a property to do it up and then sell it almost straight away to generate some income that way. Hopefully the value you get for it once you've made it look all fantastic will be more than you paid for it, so you'll get some one-off revenues, and there could be some costs involved in actually selling that property as well. So that's what's known as a flip. Again, I'm not going to cover that today, but you could build out the costs and the revenues quite easily in the same way as the costs that I am going to look at and the revenues that I am going to look at, which is the ongoing revenues and ongoing costs that most investors incur. So whether you're a buy-to-let investor or you're doing a house and multiple occupancy or rent to rent or serviced accommodation or deal sourcing, you're almost certainly going to have some sort of ongoing revenues and ongoing costs. So you would want to model those out in some detail. And then one cash flow I'm going to touch on, because it often gets forgotten, but I'll mention it because I think it is relevant, is tax. And if you're actually making money out of your properties and you've got positive cash flow, then I'm almost certain that the taxman will try to tax you. So again, you want to take into account the cost of that as well when doing your analysis on which strategy to pursue, for yourself. Right, let's crack on and get into this deal analyzer then. So what I've got in here is a simple set of calculations that I've built, and I'll try and go through it at a speed so that you can pause it, and if you want to build out your own deal model, you can do so at the same time. Maybe even copy mine on here as a starting point. This is clearly not financial advice, it's just an educational video. I'll just say it up front. You're responsible for your own calculations, but hopefully this will give you a rough idea of where to start if you're just getting started in property. And it'll take you through the way that I would analyse a deal. Just as a disclosure, I actually work in finance, so I'm a qualified accountant, and in my day job I build out quite a lot of financial models for a variety of companies. So my aim in this video is to take that and make it easy for anyone to build their own model. I think this isn't rocket science. This is something that hopefully will be achievable for all of you. Right, so what I'd normally do when I start any model is I'd clearly mark up where the inputs are. So I've got on here inputs are in yellow and calculations are in white, just to make it a bit easier to see where you're supposed to be typing stuff in. If you're building out models for someone else, you might want to protect some of the cells so that people can only type in the yellow, but I'm not going to worry about this for now. I'm just going to put them in yellow so we can see what we're doing. I've then got property purchase price, which in here we've got in as I started 160k for this one. And then from there, we can then go into our upfront costs. So unless you are buying the property outright for cash, you're not going to be paying 160k upfront. You're probably going to be putting down a deposit instead. So I assume that my deposit is 25%. And so therefore my deposit here, I've calculated that as 25%. Press F2. 25% of 160k will give me a deposit of £40,000 there. I've then got mortgage broker fees in here, so I've just assumed that's 300 quid for now. Got some mortgage lender fees as well. I've built an option to add that into the mortgage, so you can see I've got a little tick box, drop down box rather, it appears there with a yes and a no. And if you want to do the same, if you go to the data tab on your ribbon and then go to data validation, and then hit data validation again, you'll see that it can set a list on a cell, and you can say what you want to see in that list. So I've just got yes, comma, and then no, and then I've gone okay, and that gives me the option to make that yes or no, which I'll use in my calculation in a minute. Let's make that no. We'll just assume we'll just pay that up front for now. If you're buying a property, you'll probably want to do some sort of survey, even if it's only a home buyer's report rather than a full structural. So you want to add in some costs for that. You've got conveyancing and legal costs as well. I've got stamp duty in here. Now, for this example, I've built a little formula. I'm assuming that it's not a first property and it's less than the next band up, 250k from memory. But the best way to do this to make sure we get it right is to double check it in the government's online stamp duty calculator for the UK. So I've got the address there at tax.service.gov.uk. I think if you just Google government calculate stamp duty land tax calculator, I think it just comes up anyway. But if you go there, you can calculate it to make sure that you've definitely got the right number in there. But that's just an input. I've put some costs in here for refurbishment. So again, normally if I was buying a property myself, I wouldn't just type in a random number. I'd have a separate sheet in my workbook, and I'd list out all the rooms, all the work that I thought I needed to do, all the things I thought I needed to buy to get that room looking as it needed to. And then for any big work, I'd add 3 columns in and get 3 separate quotes, and then work out an average just as a starting point, and then add up the cost for all of the rooms, and then the total cost is what I then put in here. So you might want to think about building a bit more detail into your spreadsheet for that. We then got initial void cost during the refurb, so you might have to cover some interest costs, or you might have to cover council tax, or sort of other bills in there. So again, make sure you've included enough in there to cover the void costs whilst you're refurbishing, and then some contingency just for any extra costs on top of that as well. So that gives us a total upfront cash required in here. In fact, looking at this, probably the interest cost would be a little bit higher. So let's say if we put an extra couple of grand in for that. So it's out of action for a little while. So I've got an upfront cash required of just under 60k there then. And then in terms of like the annual income, I've then got monthly rent coming through once the property is up and running. I'm assuming that there will be months that the property is empty, what we call void period. So I'm assuming that on average that the property will be empty for a month, which is hopefully adequate once the property is up and running. It could be 2 or 3 though, so you could try different numbers in there to see what it does to your rent post voids. So if we were to have 100% occupancy all of the year, we would have an annual rent before voids of basically 12 times the monthly rent. So my monthly rent on here, as an HMO, I've assumed it's 4 rooms, so a small HMO at 425 a room. So my annual rent for that property would be just over 20k. Now, a lot of investors then look at what they call their gross yield. So the gross yield is basically taking the annual rent and then dividing that through by the property purchase price, which we've got up here. Personally, I like to take a more all-in view of the gross yield and include all of the other costs as well. So what I would do is be a bit more belt and braces about it. I'd take that annual rent before the voids and then compare that to the upfront cash required, which includes some of the property purchase price. I've got a deposit in there, so I take the deposit out from the property purchase price and add on the mortgage amount, so 120k, to work out my all-in gross yield there. So the all-in gross yield you can see is around 1.4% below the basic gross yield. As a benchmark, most people are looking for a gross yield on a single buy-to-let of 8% and above, and on an HMO of 12% and above. So not quite there on an all-in basis, but not far off really. And actually, if you take the basic gross yield, it's in excess of that. So one thing that we do want to know, though, is actually what income are we going to get once we take out the void. So we've already said we're not going to be able to guarantee that we can get tenants in for every single month of the year. So what I've done here is I've taken my annual rent and then taken off the monthly rent times by the number of voids to get to my annual rent after voids. And that's the estimate I'm going to use as my income. So I then got to calculate what my annual costs are going to be. And so the biggest cost quite often is the mortgage interest. So the mortgage amount that we've calculated using the numbers that we had above. So I basically said that I'm going to take my 160k in D8, times that by 1 minus the deposit amount, so 75% in this instance. And then if my mortgage lender fees is going to be added to the mortgage, so if that's yes, then I've said basically take the 995, and clearly if it's not yes, then it's not added in. So that gives me my mortgage amount there. I've then got an interest rate on here. I've just typed in 3.6%. Your mortgage broker should be able to give you a good idea of what the interest is. I've assumed this is interest only. There's no repayment in here. So that is literally just the interest cost. You could get a benchmark if you're not currently speaking to a mortgage broker from a website like moneyfacts.co.uk or Money Supermarket. You'll have various buy-to-let and HMO mortgage products on there for investors. So in this instance, it's quite a straightforward calculation. All I've done is I've taken my mortgage amount and I've multiplied it by the interest rate to get to my mortgage interest on here. And then we've got letting fees. So if you're using an agency to manage your properties for you, quite often there'll be a tenant finder fee up front for finding a tenant. There might be a letting fee as a percentage of the annual rent. Hopefully they won't charge you during the void periods, but some do. So again, I've made that as a drop down a bit like I did earlier on. And then the letting agent fees on here, the calculation I've used here is basically just taking the 1,700, and then if it includes the void periods, I'm taking the gross rent times by the percentage, and if it doesn't include the void periods, I'm taking the net rent times by percentage, and that gives me my total letting agent fees in there. I've then got building and contents insurance, should hopefully be a bit less than that, and some maintenance costs as well for the odd jobs that need to get done through the year. If it's a leasehold property or a flat, you might have some ground rent and service charges to take into account as well. All properties that have got gas will need a gas safety certificate, and then you might have some electrical appliance testing or electrical checks to do as well. Now for HMOs only, you will probably be picking up the utility bills, so things like gas and electric, water, broadband, cleaners, TV license, if you're paying for that as well, I'd add in here. And if you're not using a letting agent, you're doing the advertising yourself, maybe your spare room costs or your openrent.co.uk costs you might put through here. In this instance, if you've only got one property, you might want to include all of your National Residential Landlord Association membership fees in there, or other membership fees and accountancy costs in here as well. And then you might want to put a little bit in for other stuff, a bit of contingency, maybe a bit of ongoing refurbs over above the annual maintenance as well. So once you've refurbed a property, you will probably have to do a little bit more if you're holding it in the longer term. Certainly once it's a few years old, you'll find that various bits and pieces need updating. So the total annual costs on this property are coming out at just under 14k. So the way I've calculated that is I've basically taken my mortgage interest cost from here, and then everything below the letting fees. So in row 59, I've then just added up all of that, and that gives me my annual costs in here. So now we're on to the interesting part. Do we actually make a profit, and if so, how much? So I've done the profit calculations on two bases here. One's before tax, one's after tax. So the annual profit before tax is quite straightforward, really. We're just taking our annual income, so taking the annual rent after the voids, and then taking off the total annual cost that we've just had in here. I've then got a return on cash invested before tax of 8.1%. So that I've calculated as the 4792. And then I'll just divide that through by my upfront cash required in here, because that's the cash I've invested. So actually that's not a bad return. If you could get that in the current market, that's way better than what you'd get if you had that cash sat in a bank account. So that's really quite attractive. If I then look at what the annual profit before tax is compared to the overall property price, I then get 3%. So clearly it's higher in terms of cash return because you've leveraged the property. But if, say, for example, you was to pay for the property outright, then effectively you'd take the profit before tax and divide it by the property purchase price up here. And then if you want to go belt and braces like I normally do and get an all-in net yield, then as well as the upfront price, you've then got to take that annual profit before tax and take into account the other costs that you've incurred to get that property up and running, as well as the bit that you've mortgaged. So that's how I would calculate that in here to get to my net yield before tax. Now, I said I'd mentioned tax briefly because quite often this is a cash flow that gets forgotten, particularly if you're trying to work out how many properties you'd need to replace your income. You want to be comparing a net of tax number with a net of tax number, because your outgoings are basically net of tax, in terms of your expenditure. So you'd need your annual profit after tax to be able to cover that. Now, in this instance, I've really taken a very simple approach just for illustration. So I've assumed that this is a property that's been brought through a limited company in the UK, which would incur corporation tax at 19%. Now, clearly, the marginal tax you'd pay on your property profits will depend on whether you've bought it through a limited company or whether you've bought it in your own name. And if you've bought it in your own name, then it will depend on your marginal tax rate. So that depends on whether you're a basic tax rate payer or a higher tax rate payer. And then you've got the Section 24 complication around the interest costs. You can't just knock off the interest costs like you used to several years ago. So that needs to be taken into account as well. There are online calculators for that if you wanted to use that, or you might want to build it into your own spreadsheet. But either way, I'd say definitely think about the tax costs. Don't pretend they don't exist, because they do, and potentially take tax advice on it, to make sure you get the right tax structure set up given the property strategies and aspirations that you've got. Definitely worth considering at least seeking tax advice on that. And as a minimum, I'd say investing in a tax book or two aimed at general property investors to get up to speed. So for now, just for simplicity, I've assumed I've bought this property for a limited company. So I've taken a tax rate of 19%, which is the current corporation tax rate that I've added as a note there. And so really all I've done here is I've taken my annual profit before tax and times that by 19%. Now this is a ballpark tax figure, so I've not taken into account any capital allowances or other allowances I could claim. I've just literally taken my profit and taken some tax off to give me a rough idea of what tax I might need to pay each year on the profits from my rental property. So the annual profit then after tax, I've then basically taken the profit before tax for F2, the 4792, take off the 910 to get to my annual profit after tax of 3882. So my return on cash invested after tax, this is my cash on cash return. So after everything's said and done and all the costs are paid and the tax is paid, what cash am I actually getting back on the cash that I've invested? So that's the 3882 divided through by D33, which was our 59k upfront cash invested up here. And then one of the things you might want to do is look at, well, actually, how long does it take for that investment to pay back? So, how many years is it before you actually recoup the money you've invested? So if you take 1 and divide it by the return on cash invested after tax, so just take 1 divided through by the number above, that tells me it's going to take me just over 15 years to get a payback on my initial investment there. So it's very much long-term investment. You're not going to get the money back straight away. And clearly, I guess, if you haven't got 15 years to wait, then maybe property isn't necessarily the right path for you. But for many, it will be as a long-term sort of wealth strategy and part of their financial planning. Now, you might have noticed that I've put all of my formulas in column D. There's a reason for that. So this is just one scenario, but once you've built it once, you can recycle it and use it again. So what I can do is I can highlight that column and hit copy, so Control C, and then if I press enter or hit column F and press enter, I can copy it across and I can now run another scenario. So I've done it as an HMO, but I might want to see if it works as say like a buy-to-let. So I might want to run a buy-to-let scenario on this one, or run it with an HMO, but different parameters to run a different scenario on it. So if I was doing it buy-to-let, looking down, probably price is going to be the same, deposit's going to be the same, quite likely. It could be that actually the initial refurb might be a bit less, might not need to put as many smoke alarms and fire doors in and what have you. The contingency might want to reduce it a bit as well if you don't think you'll need as much contingency, but I'll keep that the same for now. Clearly the annual rent would be different in this instance, so let's say it's 950 instead of 1700. That brings my gross yield down to 7.1%, so a bit less than the 8% I was maybe looking for. Mortgage interest might be a little bit cheaper because it's buy-to-let rather than HMO, so I might want to take that down a little bit. It could be that actually, we haven't got any costs going through here, so they can all come out as well. Everything else we want to keep the same. So clearly the cost will be a lot less if it's a buy-to-let rather than HMO. But in terms of profit, we can see the profit's also quite a bit less as well. But then interestingly, once I take out my tax, I can see that the profit is about £1,500 sort of less than it would be if it is an HMO in this instance. So it could be, but then having said that, you could then go back and say, well, if I've only got one tenant, I might not bother using a letting agent. I might just look after it myself if it's local, and it could be that you'd save some money there. So actually when you add that back in, then it might look a bit more comparable. So you can run all sorts of scenarios then. You can stress test your model as well. You could say, well, actually, if interest rates were to go up by what would be horrendous, say 3%, if that's going to be, say, 6.6%, and that was going to be 6%, would I still make any money? And then I can scroll down and have a look. And this is the benefit of doing it in Excel, really. I can now see after tax, if the interest rates went up that much on a buy-to-let, I'd only make, it's 300 quid, not even that per year for all that effort. Makes you wonder if it's really worth it then. Whereas with an HMO, still make about £1,000, but you still need quite a few of those to replace your income if that's your strategy. So, it gives you a good idea of what changing the numbers does, which you just can't get if you did it on a pen and paper basis. This is really the benefit of building these models in Excel. Look at that, the payback on that would be over 200 years. So that'd be a very long payback on that one. So hope that gives you a bit of an idea of how you can use it. Now, clearly you can make more than one copy across the page. You might have like sort of 10 properties you're looking at. You could just copy it across like that. Copy my little column in between as well. Hold down Control and highlight the columns, press Enter, copy like that. You could run a whole bunch of analyses, just building that deal analyzer the once and then copying it across and running different properties and different scenarios for the same property through there. I hope you found that useful. This is a video that I will upload hopefully at some point this week to YouTube so that you can download it and watch it in a bit more detail. I hope you found it helpful. If you've got any questions, please let me know. But in the meantime, thanks for watching.